We're delighted to have these three speakers in our first panel. Of course, as I said before, Philip, thank you for pushing forward over the years with this concept, with this conference. Philip Lane is the chief economist of the ECB since 2019. Before that, as you know, he served as governor of the Central Bank of Ireland 2012 to 2019, and prior to that he had a wide-ranging academic career with PhD in Harvard, assistant professor in Columbia at the University of Columbia, and professor at the Trinity College in Dublin. He will be our first speaker, so the structure will be about 15 minutes of initial contribution with slides in most cases, and we'll go through the three contributions and then have a first round of questions and hopefully second and third depending on the time. I will introduce all three speakers right now, and Philip, you can of course then speak from here or from the table, whichever you prefer. So our second speaker, Richard Clarida, it's also been at previous occasions here at the ECB Watchers. I remember also some times we could celebrate afterwards in Frankfurt. So it's great to have you here again. You served as vice chair of the Federal Reserve from 2018 to 2022. So we will be particularly interested also in your perspective on the US. I think, as I also tried to show in my slide, there are interesting elements of comparison and timing and causal factors. So we're looking forward to that. You served also as Assistant Secretary of the US Treasury for Economic Policy, and you're a long-time global strategic advisor with PIMCO again, and of course since 1988 a professor at Columbia University. And our third speaker will be Evi Pappa. Evi is full professor of macroeconomics at Universidad Carlos III in Madrid. She has held previous appointments at the London School of Economics, Bocconi University, the University Autónoma in Barcelona, the European University Institute, and she's a co-editor of the European Economic Review, and she's a member of the CPR Business Cycle Dating Committee. So we're looking forward to your insights from the academic perspective, both on US and Europe, but also, of course, importantly on Europe. So without further mention, Philip, please, it's your turn first.
Okay, good morning, everyone. Thank you, Volker, for organizing the event, and it's great to see such a big turnout. And I suppose after having a couple of online watchers during the pandemic last year, it was very good to see the return to in-person, and even more so this year. So the topic of the panel, I think, sets an interesting question, two sets of questions. One is really, is the inflation surge over? And then what are the lessons for monetary policy? So there's an element of retrospection here, but of course there's also an element of what remains and where we're going to go next. I'm going to start off with a little bit of a pedantic point, because recently the CPR put together a book about looking back about monetary policy over the last couple of years, and I contributed a chapter. But actually, I consciously wrote in the title of that chapter, inflation surges, not inflation surge, because I think especially here in Europe, analytically, it's important to differentiate two phases. One is 2021 and the recovery from the pandemic, and the big debate in 2021 about is inflation just a blip, or is what's going on here with the initial surge of inflation? And then there was a second surge connected to the war. And I do think it's important to think about those two phases, of course intertwined, amplifying each other, but in the end I think it's important to maintain that distinction. So let me get going. Now, in the end, inflation is a general rise in prices, but of course, we do have to analytically think about within that overall inflation dynamic, what are the relative price movements? Because relative prices, in the end, tend to have some kind of underpinning to relative prices. So when you see a really big surge in some category, for example, energy, you do have to think about what happens to inflation across the economy, how persistent is this going to be? So what I show here on the left is the relative prices of the big categories since the start of the euro. And then I zoom in on the right from the end of 2019 onwards. So what you can see is there are some trends here. The relative price of energy now is, compared to the overall price level, 60% higher. There's also a big negative trend in goods prices because of globalization, technological change. The long-term trend has been goods inflation a lot lower than other categories. And in this period, we've seen some unusual movements. We saw this really big, intense surge in energy prices, which has retreated to a significant extent, but not entirely. If it peaked at 140 at the end of 22, relative to the overall price level, it's more like 120 now. Food, I think, has moved quite a bit. Historically, food is seen as quite volatile, but it's some hybrid. Food is some hybrid between energy, goods, and services. All of those basically contribute to how we think about food. And then we do have the services inflation and goods inflation looking different. Okay, so that is a backdrop. It's a fundamental backdrop for how to think about the volatility of inflation over this period. And one way to kind of put it together, now this is with the benefit of hindsight, it's basically knowing what we know now, how do we think about the drivers of inflation over this period? Let me also emphasize later on, towards the end of this talk, I'll come back to the role of monetary policy, which you don't have a monetary policy box here, it's the underlying shocks. So all of these are the shocks which intermingle with the reaction function and other factors to deliver the inflation outcome. And this is work that's just been published by the ECB, so a set of ECB authors, but it's part of a larger project which is pioneered by these little-known economists, someone called Ben Bernanke and another person called Olivier Blanchard. And they've been really helpful to the community of central banks by leading this joint effort to have a kind of multi-equation, but still pretty contained model of how to jointly think about inflation, price inflation, wage inflation, and inflation expectations, both short-term and long-term. Now, they published a paper about the US a year ago, and the implementation for us has been interesting, and I hope you can see the contributions here. And it basically says the kind of rapid increase to the peak inflation rate is a lot of it is energy. Then there's a very large contribution of food, especially in 2023. And again, food is twice the weight of energy in the price index. It's very important. And then the light blue box is what's labelled here shortages. And at present refer to the different types of bottlenecks we've seen. So essentially, if you try and explain the rise and fall of inflation in terms of the shock factors, you do have these factors which you can think of as relative price shocks. And again, relative price shocks happen, but there's also strong economics. If something gets too expensive, there are responses which lead to some reversion in that process. Let me mention also, and maybe Rich, when he speaks, we'll take it on from a US perspective, there is a visible, but not very large, labour market component so far. But this is, let me emphasize, is retrospective. It's not about what we're concerned about now. And let me turn to some other dimensions. But what's interesting here is using the same model, you can say, okay, if we use the same model for the US versus the EU area versus other countries, what shows up? So I think there'll be a comparative paper coming out. A short version of it has already come out, which I think is helpful to organise thinking. Okay, so connected to that, that was what we now know retrospectively. in real time in terms of how the forecasters were thinking about it. A lot of the really big uncertainty we had, these are 1 quarter ahead. So having several percentage points of a forecast error 1 quarter ahead is pretty big. But what this shows is a lot of this is basically what happened to energy prices was not predicted. And we can all think and discuss about, okay, do I have some unique insight into how energy markets work that would allow me to do better? So there's a very large fraction which is basically driven by the assumptions. Let me emphasize again, including how to think about food. Because food, again, is not so easy to think about. But the light grey box at the top is basically other factors, which is essentially, you can think of, a lot of it is, you have to make choices in forecasting about intrinsic persistence. What is the momentum in the inflation process? What is feeding itself in terms of adaptive expectations, catch-up effects, and so on? So the forecast, it definitely played some role, but over time, there have been corrections to that, and it's something continually under review. Okay, so then you might say, okay, let me open the history books and say, what can I learn from previous episodes? And Volker helpfully, already in the intro, talked about the 1970s. And here I'm just importing from the BIS. The BIS, of course, is a repository of information around the world. And what they did is they collected a lot of past episodes. And what I do here is I show the current euro area episode compared to that historical database. And so this episode had a more rapid increase in inflation, and it's seen a fairly rapid decrease. So again, for those of you who studied the 1970s, inflation had already built up from mid-60s onwards. So thinking about, if you like, how to think about inflation that surges from a mid-level to a high level is different to what happens when inflation is very low and rapidly surges to a high level. Because again, to the extent the low inflation is still playing a role in anchoring expectations, people could not believe going from like 1 to 10% is almost literally unbelievable. And when you have an unbelievable episode, it has implications. So let me emphasize, coming to what are we concerned about. On the right, it shows that core is coming down more slowly than historical episodes. So we do have an issue about how to think about the dynamics of core inflation in the context of this rapid overall surge. And in turn, within core, it's not goods. Goods disinflation is rapid. So it's about services inflation. The services inflation has this above a normal profile. And that's why, as the President was indicating there, this is why it is about services inflation, and we have to think about that. Okay, so let me, I'm going to come back to services in a minute, but let me just bridge it by talking about what we see right now. And so let me say that the triangles here, the red triangles, is our updated forecast. And for overall inflation, we have a further decline this year from in Q1 just above 2.5 down to low 2s in the second half of the year. Let me emphasize for core inflation, there is an important projection here of going from around just north of 3% now to 2.5 in mid-year, and then it's kind of stable around 2.5 the rest of this year, with further disinflation later on. So we do have progress. It's really important. We have the forecast is built on significant progress in core inflation in these months. And in terms of saying that we know a lot more by June, one thing we'll know more about is this playing out or not? Okay, so again, in terms of thinking about how do we think about where is inflation going, you might say, okay, massive volatility in food and energy, let's look at underlying inflation. And yes, there's not one single measure, so let's look at a range of measures. And so the standard set of measures is on that panel there called the standard measures. And this went really high a year ago. So, some of these measures were 7 or 8% inflation. The definition of underlying inflation is what predicts inflation 1 year later. So if you took those numbers in an unadjusted way, it sounded like there'd be a lot of persistence of inflation. Now, economically, when you have bottlenecks and when you have an energy shock that is so big that every sector had to adjust its pricing, you might say, let's make an adjustment. Let's adjust for bottlenecks. Let's adjust for the fact that as energy prices decelerate, that will lower pressure across the economy. So we have these adjusted measures, and again, the ECB staff have done, I think, good work developing this. And I think there was a working paper last week or so, which gives the full econometrics behind it. And of course, these provided some reassurance a year ago because the peak was a lot lower. And what it also says is as energy prices recede and as bottlenecks improve, you also get a decline in underlying inflation. And maybe the last message here, if you look at the difference, the adjustment, there's still some room to go. So when I say we do think core inflation is coming down more, part of this is the reversing in energy prices and the easing of bottlenecks is still playing a role. So the disinflation is not just about wage deceleration, it's also a fact that there's still a lot of reversion in the system according to these calculations. And one way to think about that is when you zero in on services inflation on the left. I'll come to the wage-intensive services in a second, but the services sector is really diverse. You have energy-intensive services like transportation, for example, and a lot of tourism-related services are quite energy-intensive. But we also had what we labeled pandemic reopening effects for contact-intensive services. So the green line here is the category contact-intensive services. This is definitely where there's a preference shift after the pandemic. So the inflation rate for these categories last summer was like 7-8. So really high inflation in services, but it was not being driven by wages. It's basically just the reopening effects, really high demand for contact-intensive services. And that's where the big disinflation in services has been. This has come down a lot. So let me then say, okay, we're paid to worry. So let me go to wage-intensive services. So the light blue line, it's decelerating, but in a very gentle way. Now, the peak is lower, but it's still, as President Lagarde was mentioning, it's still north of 4%. And this is where it's quite tightly connected to wage developments. So we're not making this up. There is a substantive issue now about where overall in services, the easy wins, if you like, the services disinflation from the end of the pandemic reopening is playing out. There is a contribution from energy easing, but we have a fundamental issue here about wages and prices. And if you like, in the momentum, again, it wasn't the President's speech, momentum got very low at the end of last year, essentially because the energy cost was deflating, the bottlenecks easing meant there was very little overall cost pressure. Labour costs going up, but overall costs not. Now we have something that we expected and we would expect to continue, which is there are upward pressure on services inflation from wages in particular. We don't have the windfall of lower energy prices repeating itself in the same way. So what we need to see is momentum, if essentially consistent with getting back to 2% inflation, not zero momentum. Zero momentum would be basically a deflationary setup. Okay, so where are we on labour costs? So let me build this up. So the left chart shows you what's happened so far. And essentially what's happened so far is you can look at that chart and say, last year there was a big run-up, a wage acceleration, and then it started to turn around late in the year. So what we want to see is a turnaround late in the year continue this year, next year, and the year after. So the middle panel is the projection, which does have this deceleration, which is basically built on the real wage catch-up. So the gap to rebuild real wages each year is getting smaller. Is fundamentally the main part, and some degree of softening in the labour market. And unit labour costs decelerating more quickly, under the conjecture there has been labour hoarding, and as the economy recovers, there's not a need to increase the amount of employment, and therefore productivity will pick up. Let me mention the European labour market is complicated. We have lots of different countries. But one basic factor, if I go back to the left panel, is last year minimum wage increases, the purple dotted line, was nearly 10% inflation rate from minimum wages. And so that's a big environmental context for the overall labour market. This year it's going to be more like 4%. So the overall mix of how the European labour market works, the role of legislation, minimum wage increases, played a big role last year. It's going to play a smaller role this year, basically because of lower inflation rates. Let me mention also the softening of the labour market is visible in factors such as much lower wage drift contribution, which came down a lot last year. And so when we try to go beyond what we know from Q4 and think about this year, the wage trackers are helpful because it's a mix of the 2024 wage increases built into multi-year agreements signed last year and the year before, and then what is new. And the red line is what is new. The dotted line is just saying in Q1, we have some information, we don't have all of the countries reporting, and that's why it's still a kind of incomplete series. But we are seeing deceleration. What we need to see is more. Let me mention also, yesterday the labour cost index came in a lot lower. This is an hourly measure. There's more progress in that than some of these other measures, but I think we're still working through how to understand that. Okay, so then we have to think about, okay, you have still elevated wage increases, above steady state wage increases. So to have the overall drop in inflation we project, you also need to see profit compression. So what we have seen is to some degree last year, see that in the behaviour of unit profits in the left, and then you can do a transformation, think about profit margins on the right. Economically, the reason why we think this is plausible is the level of profitability in 22 was high. So if you look at firms' annual reports for 2022, they were unusually high. This is a convergence back to normal level of profits. It's not a profit squeeze in that sense. Let me also mention one of the stories ECB has been promoting for all throughout this is taxes. The subsidies at the end of 22 were really important in containing inflation, but as those subsidies get reversed, it does put upward pressure, and you see this in the contribution of unit taxes. So Q4, you can see quite a contribution from unit taxes, which this year we think will be there again as VAT rates get renormalized and so on. So if you want to do the full calculation, you need to think about that. Let me briefly talk about confidence in the return of inflation to target. So most of last year, we had a phrase in the monetary policy statement, inflation is set to remain too high for too long. So even though we did have projections where inflation would be more or less around 2% in 25, we still had a 2024 inflation number closer to 3%. And when you think about the environment, if inflation is far away from target for too long, updating of expectations, adapting expectations, the pressure on wages, it's plausible a lot of that would still be quite intense this year. So compared to September on the right side, we've marked down the 2024 inflation number. A lot of this is much more benign gas prices. But what it does mean is the distance to target this year, it's still there, but it's lower than we previously expected. And that, if you like, in terms of the overall inflation dynamic, makes it less risky. Now, for completeness, I also put in, we have also been marking down GDP for this year from a 1% growth rate last September to a much lower number now. And that also influences the inflation environment. And so when we think about the overall risk environment, again, the fact that the 2024 inflation number is lower helps. When you look further ahead, the 5-year last summer was quite elevated. Whereas now that's come down, which is a market sense that the risk profile has differed. Also, their kind of option pricing is also coming down in terms of the risk will be indefinitely far away from target. So again, in the context where we are kind of cognizant not just of base cases, but also risk, this is relevant. Okay, let me finish with a couple of comments about monetary policy. So this is just a reminder of what we did, which is basically in the pandemic itself, we held rates at a low level. And then, of course, we had this hiking cycle and then this holding phase. And then the world believes eventually there'll be some kind of cutting back towards some kind of version of normal. But as a reminder, in the pandemic, the focus was not on the policy rate, it's on the balance sheet. And you can see this really sharp increase in the balance sheet between the teltros especially and PEP. And then a lot of this is now reversing. So a lot of monetary policy action was taken in the pandemic. And then, of course, we had this gear change from being accommodative towards being ultimately restrictive. And that was a big gear change to make. Let me just make that basic comment. And so what you see is that a lot of this was in the year 2022. If you think about the yield curve, in 2021, the market did not believe that rates were going to go up. Even in December 21, is still a very low yield curve, even though by that point inflation had gone up. So the big action was in 22, and then of course we did further tightening in 23. So that's a big change in the financial system. Also, there was a change in how banks behave. They had to move from a situation where our balance sheet was growing and the yield curve was very low. And so this loan supply indicator moved from being very supportive to being in a more restrictive setting. And so I'm not going to try and have a big account of all the impact of monetary policy, but broadly speaking, the increase, the pass-through has been in line with what you expect, if not a bit stronger. And the movement in credit has been faster than you might expect. Again, when you do a very large movement, and there's a big permanent component here. No one expects us to go back to lower bound anytime soon. So a lot of this is permanent in nature. Then there's a bigger adjustment in the financial system. Okay, so now I'm going to bring it back. What's the connection between what we did in terms of monetary policy and the inflation dynamic? And here, again, I'm just going to import from the BIS. This is a model which they used in a nice paper in December. It's based on US data, but the point, it's a modeling point, not really a data point. And so what it takes on it's easy to think about the policy rate here. There are three scenarios. So if you believe this is all just a shock that went up and then is reversing and there's no role for monetary policy, you're interested in knowing what happens if we left policy alone. And that's the orange line, leave policy alone. A second version is how does the model behave if no one has any uncertainty that inflation will come back to 2%. That is the red line, so full anchoring. And then the blue line is what happens if an inflation surge creates a bit of uncertainty, that people start to worry that the inflation anchor is not perfectly secure. And it turns out if there's some degree of uncertainty about that anchor, and remember this is a very unusual situation, you have to tighten more. That's one basic message here. The blue line is sharper than the red line, because if inflation infects expectations, you want inflation to come down more quickly. So the middle panel shows you what happens is, compared to perfect anchoring, with some uncertainty, inflation doesn't fall as quickly because expectations do get infected until they see inflation coming down. So under that model, you have a big monetary policy reaction, but it takes time for inflation to come back down, in part because of this expectations channel. But what's important to say is if we did nothing, inflation would be a lot higher. So because if you have no anchor, say, well, they're doing nothing about this, why should they expect inflation to come down? So the exact same shocks, which are temporary in nature, turn into permanent inflation. So the monetary policy was to make sure this remains a temporary shock. Because without the monetary policy response, inflation, the expectations would have de-anchored and you would have permanent inflation. And by the way, initially, if you have a very low interest rate and high inflation, you do get a boom. And the left side says you would have had a big increase in GDP initially, because with super negative real rates, and you say, okay, I have to take advantage here, which we did not see. So we did not see any kind of demand boom, any kind of instability. So our monetary policy was very stabilizing in that sense. We avoided the procyclicality of high inflation and a low policy rate taking over. And a different question sometimes people ask is, what would have happened if you'd moved more quickly? So this is the ECB team put together. Now, there's many counterfactuals you can do. So here's his two counterfactuals. One, which, especially with the benefit of hindsight, many people claim, which is you should have moved in autumn 21. And so here, the yellow line is maybe the more interesting one. Okay, you should have moved earlier, not a bigger peak, go to 4%, but go earlier, and then they basically say, then you connect to the path currently expected. Whereas the green line is much more, look, single-minded, let's really have a sharp increase in let's really kill inflation quickly. So the green line is go up to 6% and hold it. And so the right panel shows you, according to models, what's expected. You would have seen, yes, lower inflation. I leave it to you to judge. Is that a very large decline in inflation compared to what happened? Or with fairly flat Phillips curves, how much you would have disinflated given the size of the shocks? And then the models also remind us, with those paths, the path for GDP would have been a lot lower. So in other words, in order to squeeze inflation earlier, there would have been a price to pay for that. Again, I'm not commenting on what, with the benefit of hindsight, what would have been optimal. But it is a reminder about the role of monetary policy in this world where there's really large shocks going on. So with that, let me stop.
Let's get the slides up. Tough act to follow. Let's see. Is someone going to get the slides up? There we go. Very good. Well, it's really a treat, sincerely, to be here. It caused me to think back on my first visit to Frankfurt, which was in 1996 at Ottmar's invitation to the Bundesbank. And I remember that, and also remember attending this conference that Axel invited me to back in the pre-GFC era. So it's been too long, and thank you for inviting me. I will be focused, not surprisingly, on the Fed outlook and the U.S. Outlook. My remarks will be mostly retrospective to provide some context, and much of what you see will be in alignment with what we saw from President Lagarde today as well. I also feel that for those of you who are familiar with the National Football League in the U.S., before every game there's both a pregame show and a postgame show, and of course today at 2 p.m. U.S. time, 7 p.m. Frankfurt time, we'll know what the Fed ends up doing at this meeting, so there will be an element of that as well. In my first slide here, and I will say that now that I'm back at Columbia, I don't have an eager staff to do fancy charts. So there are a lot of screen grabs here from Bloomberg, but at least they're up to date. I begin with the chart just showing you to provide some context for the pandemic shock in relationship to a long history of U.S. data and unemployment and inflation. One big difference between the U.S. And Europe is the way in which U.S. policy typically deals with unemployment in a downturn. In general, in the U.S. system, we don't try to preserve the connectivity between workers and firms. Workers leave firms and then get checks from the government. And as a result, we saw an incredibly enormous increase in unemployment. The unemployment rate went from under 4% in February of 2020 to nearly 15% by April And I can tell you, as a policymaker at the Fed in the time, that's a chart you don't want to be seeing. Of course, the decline in unemployment was also quite rapid, indeed much more rapid than in any prior cycle, and this factored in as well to real-time thinking. The chart also shows you the surge in core inflation in 2021 and 2022. I can say in real time at the Fed, although we didn't have a detailed quantitative decomposition like is available today, we intuitively thought that we were seeing both supply and demand shocks. I will confess I was a charter member of Team Transitory. Initially in 2021, the inflation surge was really not broad-based. Indeed, I think in the first half it was primarily driven by used cars. And I remember saying to Jay Powell at one point that I wasn't prepared to raise rates and throw people out of work because used car prices had gone up. But certainly by the fall of 2021, the U.S. data was indicating a much more broad-based inflation in which both supply and demand factors had to be at work. I can say one frustration that I've had with some of the Twitter commentary that I've seen in macro in the last several years is, I guess because of the Twitter constraint on the number of characters, a lot of commentators feel compelled to attribute a very complex outcome into a very simple explanation. So you have it was all supply camp, you have it was the all demand camp, and I think the truth is both supply and demand factors were relevant. And as Jay Powell has said many times, there's not much the Fed can do about supply, but obviously the Fed has the tools to address an imbalance between demand and supply. So in the category of what were they, the Fed, thinking, misery loves company. The initial transitory diagnosis was broadly shared, in particular economic forecasters, private sector forecasters, the Booth survey, the people who actually get paid money to actually have a good forecast of the CPI because they're trading inflation index bonds. So I think the lesson learned for future policy makers is that when there are truly exogenous big six sigma shocks, I think the human brain is wired to see mean reversion, especially when you've had a history of 25 or 30 years of price stability and supply shocks that have mostly been mean reverting. Obviously, the lesson of this crisis is to be alert to other possibilities. In terms of Fed liftoff, the Fed, of course, lifted off in March of 2022. I agree with both what I saw in Phil's discussion and other discussions that it's always interesting when you're having these conversations to have some counterfactual in mind. And so one counterfactual is just to think about outsourcing Fed policy to a Taylor type rule using real-time data. David Pappa and co-authors do this exercise and update it. And what I like about David's work is that it uses real-time data to do these counterfactual charts. And it also does so in the context of an inertial policy liftoff, since in both in theory and practice, central banks do tend to move inertially on adjustments. And so essentially what you're seeing here in the orange and the blue lines is what Fed would have looked like with an inertial Taylor type rule given the data available. And of course there was a delay. The Fed ended up lifting off in 2022. I don't have the time here. I have written pieces, MBER and Project Syndicate, in which I lay out in more depth, at least what I was thinking during that time. But in particular, this sort of quantifies the delay and also quantifies the reaction. In terms of where we are now in the U.S., of course, the Fed is an inflation targeter since 2012, and the price index that it targets is the PCE index. When I arrived at the Fed, I actually asked the staff at one point about that and was told maybe it's an apocryphal story that Alan Greenspan always thought the PCE was a preferred measure, and so that's the one the Fed targets. And if you look at core PCE, and I think that's the appropriate metric since core tends to be a better forecaster of headline than headline, core PCE, whether or not you look at 3, 6, or 12-month rolling averages, annualized, is definitely comfortably, and I would judge going forward, will remain comfortably in what I call the 2-point-something range. And this is not to be flip. I mean, we're in an environment where the target is 2, but the Fed is starting to think about adjusting rates in the context of being close to, but still somewhat above. However, as I think many, if not most of you, are aware, another unusual thing among the many unusual things in this episode is an enormous, historically anomalous wedge between CPI inflation and PCE inflation. So if 12 years ago, Ben Bernanke and the Fed had chosen to target CPI inflation, right now the story would be much different. 3-month core CPI is above 4, 6-month core is close to 4. And so let me be very clear, if I were still at the Fed, I would be basing policy on the PCE. In particular, one of the big differences is that the PCE has a much the CPI has a much higher weight for the owner equivalent rent calculation. And as a result, since I personally believe that we don't measure owner equivalent rent either very well or in a relevant way. That's part of, I think, the reason for the Fed to be focusing on the PCE. But nonetheless, I think we do need to be humble as looking at the economy, and when two common indexes are giving such divergent views, I think it makes sense to put some signal there, especially, and I'll talk a moment about risk management. Wage inflation is obviously relevant. I used to make the point in speeches as Fed Vice Chair that the Fed has a price inflation target, not a wage inflation target. So personally happy when everyone gets a big raise so long as it's commensurate with productivity and the price inflation target. Wage inflation, again, is moving in the right direction. And if you look at average hourly earnings over the last 3 months, annualized at a little bit under 4, and coming down. Of course, what's relevant to price inflation outlook is wage inflation adjusted for productivity. The productivity data in the U.S. is always volatile. It's subject to big revisions. Things that seem obvious with 20 years of hindsight were not known in real time. This episode in particular was striking. So if you just look at the official productivity data in the U.S., we had this innovation boom in 2020. Then we forgot everything we learned in 2020, so the level of productivity fell for 2 years. And then last year, productivity growth picked up to a healthy level. If you just smooth out the pandemic gyrations and you look at the level of measured productivity compared to 5 years ago, it's more or less at the pre-pandemic trend, which is maybe 1.5% in the U.S. context. So I think the best bet, if you're a policymaker, is probably to try to tune out that noise and not assume that there's either a boom or bust in productivity here. And I think that's relevant in assessing wage dynamics. Now, in terms of the labor market, there was, of course, a very, very policy essential discussion which spilled out into a public debate about how would the U.S. labor market adjust in order to bring the labor market into better balance and into a balance consistent with achieving the price inflation target. This was also a debate that spilled into Twitter. So for those of us who have nothing else to do, we could follow it daily. And it was a debate, of course, between my thesis advisor and good friend Olivier Blanchard and Larry Summers on the one hand, and Governor Chris Waller and Fed board staff at the other. And in the essence of the debate, everyone agreed in 2022 that wage inflation of 6 or 7% was not consistent with the 2% inflation objective. And so the question was not, will the Fed need to engineer a decline in wage inflation? The question is, how will that be brought about. The Waller and Fed staff argument was to at least be open to the possibility that there's been so much unusual about this cycle and this shock that one of the paths of adjustment to the labor market could be through the vacancy margin, the quits margin, and potentially also later on labor supply, and not necessarily require a big increase in the unemployment. In other words, geometrically, the Waller argument was that the labor market could be brought into better balance with essentially a vertical drop in the Beveridge curve relationship between vacancies and unemployment, and not a movement along a given Beveridge curve. Now, historically, in the U.S. data, we had not seen that play out. Beveridge curves do move around, but big adjustments in vacancies typically had corresponded to big increases in unemployment. And you have to say, so far, Chris Waller has the better end of the argument. So far in the U.S., we have seen a deceleration in wage inflation. It has occurred without really any material rise in the unemployment rate, which remains below 4%. And this has been part of probably the key chart of the soft landing story or scenario in the U.S. has really been this. I'm not an expert on the European labor markets, but I understand something similar has been playing out here. Now, the goal of policy, obviously, is to achieve the objectives of price stability in the UK's maximum employment. But, implicitly, central banks really need to be focused on inflation expectations and doing whatever it takes, to borrow a phrase, to keep inflation expectations anchored. One thing that is important is there's no unique measure of inflation expectations. There are financial market estimates, there are surveys, and the like. I will say, and I continue to believe this, that when I would look at this as a policymaker, if I saw a divergence between a survey measure and a financial markets measure, I would put more weight on the surveys, because at the end of the day, it's folks making decisions about consumption and saving, and not just people trading inflation-indexed bonds. But in the spirit of looking at financial market prices before I look at surveys, break-even inflations at least give you, a daily read on what the markets are betting. Markets can get things wrong. But throughout most of this episode, break-even inflation in the U.S., at least at a 5-year horizon, never really did nudge up into a territory that would have been and that was concerning. However, if you looked at household surveys, and in particular the well-known Michigan survey of inflation expectations, it definitely did spike into concerning territory in 2021 and 2022. It is well known in the Michigan data that the Michigan surveys are very sensitive to the level of gasoline prices, not the change, but the level of gasoline prices. And so what I used to do when I saw Michigan surveys is essentially look at the residual from a regression on oil prices. But even if you do that, what we saw in the fall in 2021 and spring of 2022 was definitely eye-catching. And I think their ex-ante was a risk of, as President Lagarde referred to, a risk of second round effects or tit-for-tat adjustments. Certainly as a policymaker, that you would not want to assume away that risk. The good news is, since that time, even survey-based short horizon inflation expectations have come down to a level that would be consistent with the Fed's price stability target. Talk a little bit about how to think about the U.S. experience in terms of a standard quadratic loss function, where you essentially define the goals of policy in the case of U.S. price stability and by statute maximum employment, and then you basically look at a loss function that's quadratic in those two terms. This is equally weighted, which is the standard way Fed presents these loss functions. And I do think visually it helps to make a really striking point. In loss function space, there truly was a Six Sigma shock in terms of the loss function, and then truly a V-shape, improvement in the loss function. Again, in retrospect, a combination of an unwinding of some supply disruptions, an incredibly aggressive fiscal policy response, $6 trillion of fiscal support in 12 months. The Federal Reserve, without apology, at least for me, was all in terms of cutting rates to zero, doing unlimited QE. But the inflation surge shows up in loss function space as this increase in the loss that we see in 21-23. Now, I've labeled this here, as a price level overshoot. I think at the time there was an ex-ante risk that it could turn into a permanent or at least very inertial rise in inflation. But I do think that to the extent that we do see U.S. inflation as projected return down towards target, in retrospect, when the Milton Friedman of the year 2050 writes the monetary policy history of the U.S., I would hope that the retrospective look would look at this in the context of the policy support provided ex ante, at the benefit of a very rapid recovery, but at the cost for at least a couple of years of a price level overshoot. We will see. Talk a little bit about financial conditions, because of course, very few people, including very few banks, borrow at the federal funds rate. And so Fed policy is transmitted through longer-term yields, credit spreads, and the like. One thing that I always found useful in thinking about monetary policy and bond yields is something's got to anchor bond yields. There's got to be a reason why bond yields were higher in years ago than they are today. And to me, a good place to start is just to think about an estimate of a neutral rate and adding in the inflation target. And if you sort of overlay the orange line here, which is a Laubach-Williams R-star plus 2%, and bond yields, you see a mean reverting relationship, which is actually there in the data. And so in particular, when you do see a big move up in bond yields, it can reflect expectations of policy. It can also reflect developments in the sovereign bond markets, in particular term premium. The thing about the term premium is, like R star, it's really, really important, but you don't observe it. You have to infer it from models. So to make this point, this is just a daily plot of 4 different measures of the term premium on a 10-year U.S. Treasury. The good news is that they rise and fall together, but if the question is, what is the level of the 10-year term premium in the U.S., currently, depending on the model you look at, it ranges from 0 to 1.5%. So I think, like R star, term premium especially may be relevant in thinking about how restrictive monetary policy is. So I'll conclude in terms of the outlook by telling you what the Fed said about its outlook as recently as December. Again today, or this evening in Frankfurt, we'll get the new SEP projections from the Fed with a new set of dots. The last time the Fed did this exercise in December, the median participant of the 19, the median of modal outcomes thought that 3 cuts would be appropriate in 24, 4 cuts in 25, 3 cuts in 26. And as of December, the committee had not really changed its view of the long-run neutral rate, somewhere in the range of 2.5 to 3%. For what it's worth, were I still at the Fed, and I'm not, this would look like a pretty sensible path to me. But again, to reinforce something I heard from President Lagarde, I think this is an environment where being data dependent is going to be absolutely critical in this juncture. One thing, just a little bit of advertisement that the Fed now does that historically it did not do, is that the Fed now provides in a very convenient format 4 times a year, not only its projections, but also, if you will, a time series of the balance of risk to these projections. So for example, the bottom chart, which I've circled, is a diffusion index, which is the number of participants who think that the risk to inflation is to the upside, minus the number of participants who think the risk to their inflation outlook is to the downside. And so certainly, although the risk to inflation on the upside have been coming down a little bit, they're still elevated relative to history. And I think in particular this is really the first cycle since, at least in the US, since the 80s, where policy has been aimed at bringing inflation down materially. And given the importance of keeping inflation expectations anchored, certainly I do think risk management is going to be a critical part of the discussion. And so finally, I'll conclude with what do markets think the Fed is going to do? I took this screenshot, I guess, Monday morning. So maybe it's changed since then. So as I mentioned at the December meeting, the Fed indicated, at least the median participant believed, that 3 cuts would be appropriate this year. For reasons that are not unprecedented or not surprising, financial markets heard that and immediately priced in 6 or 7 cuts for this year. That has since been more or less, that's more or less been a U-turn, and we're more or less now going into today's meeting of the Fed in terms of pricing where the Fed was in December. So I think I'll leave it at that. Thank you again for inviting me, and I look forward to the rest of the discussion. Thank you.
Thank you, Richard. And so we now have Evie Pappa. And Richard, I can mention, I think in May 2022, we had Chris Waller give a distinguished lecture here on precisely that topic.
Oh, wow.
So
okay.
It's interesting to see how the data played out. So, Evie.
Thank you very much. If you don't give me some slides, I can just start talking, so it's fine.
I'm sure they will.
Well, thanks a lot for inviting me. So everybody today here is talking about disinflation, so it's here, it's happening. So what we have to remember is not forgetting about inflation volatility. So relative to the other speakers, what I'm going to do today is that I'm going to zoom out and try to be like more academic, like more pedantic, let's see. So what I want to tell you is that I understand that you are eager to see interest rate cuts. But at the same time, what I think is that what the ECB and the Fed is doing is actually justifiable. And what I'm going to do is that I'm going to give you some arguments for why they have to be hesitant, why they have to be reluctant in changing rates fast. And I will even claim at the end of my talk that actually moving back to strict inflation targeting wouldn't be a bad idea. So the outline of my talk is like, you know, I'm a poor academic, so I did my own calculations together with some people from the Bank of Spain on what has driven the euro area inflation and the US inflation. And then I will look at these facts and try to see what is in front of us, what is going to happen in the medium term. And actually, what I see is an increase in inflation volatility. And this is something the central bank should take into account. And after that, I will move to tell you what this means and what theoretical models would predict about how monetary policy should do in such an environment. So let me start with some work in progress that I have with people from the Bank of Spain. I think Jaime is here, so hi, Jaime. If they ask me difficult questions, you will answer. What we do here is basically we use a structural vector autoregression. Now you tell me what is this. So basically, in a structural vector autoregression, what we do is we take a vector of variables that we think they explain the economy dynamics, and then we say, okay, we think the economy moves this way. But as you see, these movements between, for example, real GDP growth and inflation or the interest rate, they're kind of interrelated. So if I estimate this system with no kind of restrictions, I'll get some residuals that they are correlated. I cannot interpret them as one thing or the other. So what I'm going to do is that what we're doing is we're using sign restrictions in order to recover shocks that for us have some economic meaning. So, for example, and by the way, when I say shocks, I mean shocks. I don't mean shocks, you know, like I'm in Greek, so this can be a bit complicated. So, what we are going to do is that we are going to think that the economy is going to move based on 5 shocks that we will think that they're demand, supply, monetary policy, bottleneck shocks, and oil price shocks. These bottleneck shocks come from an index that is produced by the Bank of Spain, where they gather information from like the newspapers, text messages, and they build up this index that actually measures the supply chain pressures in the economy. So, to give you an example, a demand shock will be a shock that will move inflation and output in the same direction, obviously. Okay, I will not go into details. What I want to show you is this plot. So here what we see is the euro area and the US dynamic on the right. And I guess this is the thing, yes. So what we have here is that the blue bars are like demand shocks, monetary policy shocks are the green bars, and then we have bottlenecks, the cyan lines, or actually bars. And then we have like oil, which are purple, and red is going to be like the supply shocks that we see, and the black line is the actual inflation. So what we observe there is that, you know, sorry, I forgot. The orange line is COVID. So we put like as an additional variable in our system, the COVID. So what we see is that most of the increase in inflation in Europe was actually due to supply shocks and less so due to demand shocks. Instead, if we look at the US, the picture is different. To show you this a bit better, what we do here is we accumulate the increase in inflation in between Q4 and 2022 Q2 and the phase of the decrease in inflation. And what we observe is actually that more than like half, like 2/3 of the variations of the upsurge in inflation in Europe was due to supply shocks and much less to demand shocks. The picture is different in the US. Demand here has, probably fiscal policy, has contributed a lot to the increase in inflation in the US. And what we see nowadays is we see this going down. And what we observe, it is the reversal actually of these supply shocks and bottlenecks that is bringing inflation down. Now, why I say that? Well, because I think that we have to think, are there going to be more supply shocks coming, and what are we going to do about that? And I said, okay, let me look a little bit at the numbers. So I look at oil prices, and these are real oil prices, and I look at their volatility lately. So what I observe is that there is some change in the volatility of oil prices. Here we have a much lower standard deviation of oil prices versus this recent period. So maybe another large shock could come. You know, it looks like the volatility of real oil prices has changed. Moreover, we know that climate change is here. You can see it. I mean, we are in Frankfurt, it's end of March, and it's pretty hot. So, and climate change comes with natural disasters. And natural disasters, like, have been growing. This is work from people from the European Commission. This picture, like I just borrowed. And what we know also is, like from some paper from researchers of the Bank of France, is that these disasters induce temporary but statistically significant changes in headline consumer prices. And moreover, there's some work of people in the Kiel Institute that they use disasters in euro area, and they show that these pass through, and they pass through more pronounced in the prices of food. And before, Philip has shown us that we have some food inflation, so we might want to think about that too. And last and not least, we are going to go to a green transition. We are pushing for that. But if we look at this paper from the Journal of European Economic Association of Conrad and Weber Di Mauro, what we see is that actually the price of carbon, like when it started enacted up to the 2018, is very different in European countries. Like Poland is really very much behind. So we should expect to see some increases in the price of carbon. And theory tells us, I have a paper with some researchers in the Board of Governors and a colleague in Carlos Tercero, that we show that this increase in the relative price of brown energy can actually be inflationary, and more so if monetary policy is restrictive. It's not restrictive, sorry. So now you tell me, okay, why should we worry about inflation volatility? Why you're coming here like the Greek oracle and tell us, oh, be careful, inflation volatility is there. So I say that because there is some recent research by Zino Enders, who is somewhere here, and researchers in the Bank of France, that they document that there is a more substantial pass-through of cost and monetary policy shocks with respect to periods of high inflation volatility. Now, the argument behind why this happens is that firms faced with increased inflation volatility, what they are going to do is that they are going to increase the frequency of price changes. And actually, there is ample evidence on that, like in current literature. So, Cavallo with his co-authors, they show that if we look at food prices and beverage prices, and we look at the last episode of the large shock in energy prices, we see that actually the frequency of price changes has increased. The same is shown by other researchers using UK data. And myself, with other researchers in the Riksbank, we have a paper using Swedish data, in which we do show that there is this state dependence in pricing. And here is a graph of our data. So what we have here is Swedish inflation, the black line. And now what you see with the green line is positive price, the fraction of positive price changes, and the red line is the fraction of negative price changes within the firms that we have in our sample. As you see, in the tranquil times, we have some guys changing their price up, some guys changing their price down, and inflation is kind of constant. However, when the shock comes, you see the number of positive price changes increases a lot, and the one of negative price changes like dramatically down. So why this is important? This is important because it looks like as if the Phillips curve is steepening. We see that when we look at, when we estimate the elasticity, the price elasticity of supply for our Swedish firms. So what you see here, the blue line is normal times. This is the elasticity of supply for Swedish firms in different months from the time that the shock occurs. We're here assuming a demand shock. And we see that this elasticity, let's say 16 months, is 0.4. Instead, in the latest period of the inflation hike, this elasticity goes up to 1, and it is significantly different. So if there is a steepening of the curve, we should know that. Now, there is something that nobody talked about, and it is probably the elephant in the room, because we all know that, everybody thinks, oh, the US is doing better. Output is like going down, output is going up, they are back to trend, and inflation goes down, and in Europe it looks like we are more sluggish. Well, in Europe, we have this picture. This is Economic Policy Uncertainty Index for the latest period since 2019. For the blue line is Europe, and the red line is the US. You see, we were going together in uncertain times, but at some point, when the war in Ukraine has started, we started deviating. We face an increased uncertainty in Europe. And why it is important to take account of that? Because with increased uncertainty, monetary policy is weaker. It cannot deliver as in an environment with low uncertainty. Moreover, the fact that there is uncertainty means that the firms that they have already hiked their prices, they will not be willing to take them down so easily. Why? Well, because, they don't know where it's going to come. There are elections in Russia soon. What Putin is going to decide when he's going to be reelected, because we all know he will, is something that we don't know. So this kind of uncertainty is waiting much more in Europe, which is next door to Ukraine relative to the US, that have the war very far away. And this uncertainty, as I told you, I have some evidence to show you that when uncertainty is high, firms do not want to change their price. These are estimates of the price elasticity of supply in periods of high uncertainty, the blue line, versus periods of low uncertainty, the green line. So what we see is that firms changing faster their prices when inflation volatility is high. Well, good. The steepening of a Phillips curve is something which is very welcome. Why? Because it looks like we can actually move our demand down with a higher steep in the Phillips curve without so many costs in terms of output or unemployment, and that is what we have observed. However, we have to be careful because this steepening can be asymmetric. So some researchers from the ECB have shown that price decreases are sticky, especially when there is trend inflation. Moreover, I think, as I told you before, that this higher uncertainty in the euro area can make even this last mile of the decrease in inflation even more difficult. So What should monetary policy do? According to the work of Zenon and also earlier work by Mick DeVrew, they model firms in a new Keynesian model with sticky prices and all this stuff that you don't want to know about. But what they show is that firms in this model, they can actually invest in price flexibility. So when inflation is very volatile, what these firms find optimal to do is to invest in technologies to be able to change soon their prices. And as a result, they are going to be more flexible in an environment of high volatility. Now, Cavallo et al., they show in another model that a large shock actually shrinks the firm's profits, and as a result, firms are pushed to change their prices. I think that in both models, in different degrees, the lesson for monetary policy is like, stabilize inflation, be strict on stabilizing inflation, not only directly through the demand management, but also through expectations. If you are strict that inflation should be 2%, and that's the anchor, that is good also for the firms to realize that whatever is going to come, it's going to be transient. You are going to go back to target. So for me, it looks like that maybe strict inflation targeting could be the time in high inflation volatility regime to go back to. And I would like to say that I think that we have seen projections, we will see more projections, and projections can be in and out or about. So I think that it is better to rely on numbers, on seeing inflation going down before we do anything, like in terms of policy. And in such a volatile environment, if the Phillips curve is really steepening, any ease of policy can lead us again to a surge in inflation. So we better be careful. I think it is better to undershoot than overshoot inflation. And I would like to thank you for your attention, and I'm welcoming any kind of comments.
Well, thank you, Evie. Excellent to get the data and analysis both on the US and Europe. So we go right into the questions. We have 4 lead questions, and I would call you up. Let's take the questions in one row, and maybe we can take some notes what the questions are, and then we respond, maybe all of you, or depending who is asked, and then we have time for another 1 or 2 rounds of questions. So in this round, I have Ulrich from DekaBank, Michael Krause from University of Cologne, Beat Siegenthaler from Rokos Capital, and Marco Stringa from Element Capital. So Ulrich, you're up first.
Thank you. Thank you very much. Thank you for the presentations and the insights. Very inspiring, very comprehensive. What strikes me in this discussion about the current inflation episode is that monetary factors are completely absent. We talk about energy price shocks, about inflation expectations, second round effects, and so on. So I would be interested in your assessment. Are informations from the monetary sector, monetary aggregates, completely out of the discussion, completely without information about that, what's going to happen, and explaining what has happened, or to put it more bluntly, is inflation in the 21st century no monetary phenomenon any longer?
Thank you. So next is Michael Krause.
Yeah, thank you very much. Thanks for the exciting presentations. I have 2 questions mainly to Philip. One is backward looking, one is forward looking. I remember 2 years ago when we had the inflation surge and you presented the forecast for inflation going forward. It was predicted to fall very fast within half a year or so. And now, 2 years later, we have accepted that there's much more persistence in inflation. So I wonder whether, you presented us a shock decomposition of the contributions to inflation, I guess based on current data. But what has changed? Has something changed in your models that allows you to better predict inflation now or explain inflation now that you didn't have in the models then. So I'm thinking of persistence of real wage demands, so real wage persistence. We don't see in the shock composition the labor market, but the labor market must be in the background because it must be modeled how fast real wages adjust. So I would like to know whether you made an analysis what had to change to make the shock decomposition look the way it is. And my forward-looking question is relating to real wage demands. I mean, if we as an economy or as a region are poorer because of higher energy costs and supply shocks, and these shocks are predicted to last long, then workers cannot demand to reach the same real wages that they had before the crisis. So when do you think workers will give up expecting their wages to yield real wages that they had before the supply shocks that we had? Is there some assumption you're making on that?
So, Beat Siegenthaler?
Yeah, thanks very much. I just wanted to ask kind of a simple question in a way, which is about the last mile and what sometimes central bankers call bumps or in the road or possibly more serious things, and whether for the academics on the panel, current academics, whether that's a kind of a theoretical concept that makes sense to you, or is it just really an excuse of policymakers, or let's say not an excuse, but another word for caution. We should always be cautious, so let's just, or is there a real basis to think that the last mile is actually harder? And maybe for Philip, in terms of the February inflation report, for the ECB being a little bit higher, was that, in your view, just a bump, or does that fall under this category already of the last mile probably being more difficult? Thanks.
Okay, and Marco Stringa?
Thank you for the presentation. We have seen this morning that supply shocks are reversing quickly. We have the policy rate comfortably above neutral, and the weak activity could actually lead to a quick reverse of labor hoarding. And we saw from Professor Pappa, steeper Phillips curve could actually make this argument a bit more on the less hawkish side. However, this is the first or a unique easing cycle, the one that we are approaching for the ECB. What is unique is that we are starting with both a negative unemployment gap, and at the same time we project barely any increase in employment rate. So the convergence to target requires ongoing margin compression. So is the message here that over the next 2 years, then the policy rate will have to remain well above neutral rate to make sure that we reach that inflation sustainable target? Thank you.
Thank you. Maybe let's start with Philip, in the same order, Philip, Richard, and Evie. And I think one question was directly at Philip, but basically everyone can respond to all questions, it seems to me.
Oh, okay, so thank you for the questions. Let me say that, no, I think it's working. At the ECB, we have a very strong commitment to monetary analysis. Honestly, but maybe that just reveals the kind of person I am. We get all sorts of data reports. The monthly monetary data report is, for me, one of the most fascinating reports we get. And the team really do a good job of kind of interrogating that data. What I do think is what we're seeing, both the kind of really big increase in the balance sheet of the ECB and then also wider monetary aggregates, and also the retracing we're seeing now. There's a lot going on. So I think money's part of what's going on, but I would kind of connect it to, in general, lots of kind of mechanisms in terms of monetary transmission through credit intermediation. One thing we've been repeatedly emphasizing is the very strong drop in credit, more than might be expected, and the interconnection between exogenous money and there's an exogenous money factor that we're obviously with the end of QE and so on playing a role. There's an endogenous money factor about how the financial system is responding. So what I would say is, I mean, I think monetary factors are very central, but it's not as simple. Let's have one equation, explaining everything. So I think money is important. Let me, by the way, mention this, and the ECB did a very nice paper recently about who's been affected by high inflation. And a very basic issue is people who had a lot of money. So the real balance effect. If you had a lot of money in your bank account, the real value of that has moved quite a bit. So there's many classic mechanisms which I think are very important. So so I would say we are not in any way underutilizing the monetary data. The second point, I think you brought up a lot of complicated issues. Let me say that what I highlighted in our shock decomposition is part of a system where there's also a wage equation. And so it's very important to think about, we do think a lot about what is driving wages. And maybe, of course, what I would say is everywhere there's two factors which are fairly fundamental. One is how tight is the labour market? And as Rich was emphasising, you can't summarise that just by unemployment, because we also have vacancies. We have labour supply growing surprisingly strongly. We have labour force participation. So I think the overall, and if you just think about the euro area, we have 20 member countries. We can look at the cross-section as well. And we look at the cross-section about where wages are growing more strongly. It obviously connects to tightness of the labour market. Then the other element is, I say, real wage catch-up. So understanding how the wage negotiation is affected by the cumulative loss of purchasing power, it's clearly been playing a role. One reason why the drop in inflation this year, or compared to what we expected, has mapped into a lower projection of core inflation for the next couple of years is we think there's going to be less pressure on nominal wages because the cost of living is rising more slowly now. So there's that. There is expected inflation. So we do think, and it's in the model that Oscar and his co-authors wrote, we do have expected inflation there, and as that comes down, that will moderate. So I do think, I mean, the issue about where is the landing zone and how much the terms of trade shock moves that landing zone, that's relevant. Of course, a lot of the terms of trade shock is reversed now. So there's a different issue, which of course differs across countries, about competitiveness. So I do think this is important. But what I would say is it's pre-pandemic or pre-shock is an interesting benchmark. You remember, you have to allow for the trend as well. Of course, the trend of productivity has been limited. Okay, let me say, going back to the model, I mean, I showed you, and we're going to have another one in the next few days. The bulletin will have the annual update of the forecast error analysis. I think it's cited in the President's speech. Most of it is assumptions, but there is an element about revising our view of the intrinsic persistence of the inflation process. That has to be, and then, but within that, what does that mean? Is that about, I mean, I think the IMF and the World Economic Outlook in October had a nice thing, which is really, it's not about long-term expectations, which have been fairly stable throughout. It's about how long you think this episode is going to last and how intense it is. So if you think inflation for the next year, the 1 year ahead is going to remain high, then, you know, of course, you want to protect yourself from that. So I think the staff are looking all the time about, are they getting that right? There was basically in 2022, there would have been a decision, let's increase the persistence. We were under capturing persistence. But let's also put in the context here, most of the variation was the shocks. It was not the getting intrinsic persistence wrong. Last kilometre, we're in Europe, last kilometre issues. Let me say that there's a few issues here. I think it's very helpful for us, before this happened, to commit to a symmetric 2% target. We don't have a zone, so any trader out there says, look, at 2.5 you'll stop, because you're close enough. We have the clarity, because one version of, once you get 2 point something, as Rich had, 2 point something, it's okay. and that we have a firm and visible symmetric 2% target. I think that helps. So the commitment is there from us. So one element of last mile I don't think is there. What is true though is I start off by saying one reason maybe why this episode came down relatively quickly is the inertia from a decade of super low inflation. And essentially now, if I'm trying to calculate inflation, and it connects to what Evie said about maybe the future is going to have more positive inflation shocks. So maybe the volatility is going to be more to the upside than the downside. Exactly where inflation expectations land in this world of, I think there's a range there we have to think about. I think with shocks, when you close at 2 point something, a tiny shock, like something that could have been like a 8.1 versus 8.4, we were focusing on the 8, not the 0.1 versus 0.4. But when you get 2.1 versus 2.4, then the volatility has a greater focus. But when I go to the February numbers, and we were looking yesterday, because obviously with the release on Monday of the detailed data, and I would say for everyone, look, I'm surprised when the flash comes out, there's all sorts of reactions. The Monday data is far more important when you can dig in, and when you look within services inflation, there is a broadness to it. But on the other hand, you have insurance, all of the insurance categories like really high. You have a lot of clustering at a much lower, not where we want. So I do think this is where we just have to wait for March data, April data. So we'll have the full reading of March and April by June. We'll have the May flash as well by the time of the meeting. So I think the issue about whether it's turn of the year effects, it's categories which don't necessarily persist. I think we would have to say, let's see. And then profits. So again, what I said was, we think profits are normalizing from a relatively high level in 22 in the aggregate. So usually you might be concerned if there's a lot of profit compression, you're going to hit the economy big time because cash flows will reduce investment and so on. This is adjustment from above. Directionally, it's been okay so far, but this goes back to policy. I mean, the way I'd phrase it is, how does restrictive policy work? It works because firms, they're confronted by workers that I need to see my pay increase. I said, we understand, but we don't think we have the demand to sustain a big price increase. So restrictiveness, it's not 0-1, and I think it's consistent with what the President said this morning. It's not, the first rate cut is not saying it's done. We go from restrictive back to steady state. It might take some time to implement, but we're done. We will be calibrating for a long time to come the balance between the level of restrictiveness we need and the rate of progress we see in underlying inflation and wages. So again, it's not a 0-1 debate, but directionally, that's where we're operating, is influencing the pricing decisions of firms. And that's through the restricting demand and containing expectations. So let's see.
Richard?
Is this on? Okay, good. I'll touch on 2 of the 4 questions on monetary aggregates and demand. Certainly in my chart, the decomposition I showed was not elaborate. It just divided in the inflation into a demand piece, a supply piece. And certainly within demand, that would be inclusive of fiscal demand encouraged by low rates or QE or just change in savings. So it was just an aggregate bucket that would certainly include monetary broadly defined. In terms of the aggregates, what I would say is two things that are relevant in the U.S. Data. One is simply that certainly pre-pandemic, the velocity and money multiplier relationships were sufficiently uncertain and not evidently mean reverting that I think over time within the Fed, there was less focus on any sort of a simple Friedman-esque quantity relationship, but certainly they're quite relevant, and I think it's quite important when you think about either in real time or in retrospect, thinking about large-scale asset purchases and QE. So one thing I do is is I look at M2 growth by netting out the piece that was just direct purchases in the secondary market in QE. The Fed pays a market rate of interest on reserves, and so fiscally, a QE program is essentially just swapping out a reserve liability for a T-bill liability, but it's roughly the same rate. And what's interesting, when you look at the US data, of course, there was an enormous growth in M2, but the growth in M2 net of the direct effect of swapping T-bills for reserves was actually relatively small. If you look at loan growth, right, so we had this enormous growth in M2, but loan growth by the banking system was I think maybe running at roughly 4.5% or 5% since 2019. So I think aggregates are important, but looking underneath the hood is relevant. On the last mile issue, the way I would conceptually think about it is similar to what we've heard from, I think, all speakers this morning. You think price inflation at some big level can be thought of as having a piece that's inertial and a piece that's mean reverting. The classic case would be the economy's at rest with 2% inflation, oil prices go up, they come down, but nothing else changes. I mean, that's a classic case where you don't think there's going to be a last mile. The real world's always more complicated. I would say there's a last mile risk in the US for two reasons. One is there's a big divergence between two different price indexes. So I think there's some signal there that is worth taking. The second is there is a very important inertial piece of US inflation, which is wage costs, both intuitively and empirically. Wage inflation tends to be inertial. And so right now, wage inflation has come down from the peak. But unless you're a real AI productivity optimist, it's still running at a pace currently that is somewhat above the pace consistent with price stability. So whether or not that turns out to be a problem or more effortless, ex ante, I think it's a risk. So maybe I would characterize it as a last mile risk as opposed to a problem, because I think it's too soon to tell. That's why I highlighted in my talk the importance of really, I think, especially in an episode where the Fed and other central banks have been not raising rates to keep inflation from going up. They've been raising rates to reduce inflation from an intolerably high level. I do think risk management considerations do really argue in favor of avoiding, what I think would not be a great outcome, which is mission accomplished, declaring victory and then finding out the inflation is stubborn or reverting. So I think both institutionally and practically, it's worthwhile to at least pay attention to that risk.
Maybe?
Yeah. So I will go to the last kilometer since it was for academics, so I will go to your question. So we have seen this morning President Lagarde talking to us about what she's going to concentrate looking at, which was wage growth, profit margin, and productivity growth. So what theoretical models tell us, and it's true even empirically, is that wages are downward weights rigid, which means that it is difficult to make wages go down. If this is the case, and as Richard and Philip just said, wage pressures are to affect inflation, we should expect to see a little bit of last kilometer effort to go a bit more down. Now, regarding monetary policy aggregates, I will agree with the previous speakers. And what I wanted to highlight here is the quantity theory of money. It's something that we usually use to think about the long run and the trends between money growth and inflation. But if we look at the data in hyperinflationary periods, it is true that money growth and inflation move together. So I would think that it is an important indicator to look at money growth and monetary aggregates to see if there are in the market any tensions of inflation. I bet that if we look at money growth previous to the last inflationary episode, maybe we will learn something about monetary aggregates and inflation growth. And yes, I would like to finish by saying again that, it looks like that we're talking here about policy, and we think that monetary policy is the ibuprofen, that we can use it if we have a pain in the neck, if we have a pain in the leg, if we have fever, but, that's not the case. Ibuprofen is good if you have fever to take it down. So monetary policy is good when inflation is feverish to take it down. Now, profit margins and productivity growth, which is very important according to my academic understanding, is something that it has to go together with other policies. This morning the President talked about antitrust. We can talk also about fiscal policy and the fact that it looks like both in Europe and in the US, government spending is what is pushing like back to track the US economy. It looks like it's not investment growth, and it is not investment growth in Europe. So I think that we might want to think about doing structural changes that would push growth further and not expect everything to happen because of monetary policy changes.
Thank you. So we have time for more questions. I would take, let's say 4 questions together. If you, okay, we already got more, but we have to, so the first hands came up here, I think Luigi and the person next to it, and then 2 hands here. We'll see if everyone keeps, and stand up and say your name and institution. And if everyone keeps it short and the replies stay short, maybe we can do another round. Right?
Okay, thank you very much, Volker, and thank you everybody for your very thorough presentation. Just one point to Professor Clarida, because I think his presentation, if I interpreted well, was quite conducive to why not cutting sooner rather than later for the Fed. I found it quite compelling. There is just one point I would like to point out, is that in the end, the main number there, as you pointed out, is core PCE inflation. But that number that you provided, 2.6%, is January. If you look at February, we know that because of what happened with core CPI, we know it will kind of align with the core CPI. So it should be between 3.5 and 4%. So if I'm the Fed and today I look at core CPI, core PCE in the last 3 months and it's closer to 4 than to 2, probably I will be more cautious than suggested by all the rest of, I would say, the quite compelling piece of evidence. Thank you.
Thank you. So the gentleman right next, yeah.
Tomasz Wiladek from T. Rowe Price. So I guess this is a question both for Philip and Richard, but perhaps also for Evie. So if we had debating cuts, or at least financial markets are thinking about central bank cuts, at the same time, both the Fed and the ECB are engaging in QT, and we sort of think it has an effect on the yield curve. It's steepening yield curves. It's tightening financial conditions via the yield curve. So how is the tightening in financial conditions taken into account in decisions to cut or not?
Thank you. Then I think Petra Garaz. Yeah.
Yeah, thanks. So there's been a lot of discussion about the notion of the potential of immaculate disinflation. So Jay Powell has been musing about it quite explicitly. Evie provided a theoretical explanation for why we may observe it due to a higher frequency of price adjustment. Richard suggested there may be a risk it may not stay immaculate. So, Philip, could you shed some light on what the ECB thinks on whether it will be able to pull off an immaculate disinflation or whether it may become more painful down the road? Thank you.
Thank you. And Vitor Gaspar, I saw here.
Thanks, Vitor Gaspar, ECB. I have great presentations. I learned a lot. One question for Richard and one for Evie. Richard, as a professor at Columbia, if you would be asked to grade the fiscal theory of the price level, given the jump in price that you documented for 2021 to 2023, what grade would you give? Evie, when you were presenting, there was a passage that I could not really understand fully. It seemed to me that you were arguing that under the current circumstances, it would be better to undershoot the inflation target than overshoot. And honestly, I could not understand why you were making that point, and I would love to get it. Thank you.
Given we're don't have that much time anymore, I'd rather take maybe 2 more questions now and then leave a final round of responses. So I have one here. If you stand up, we get a microphone. Yes.
Thank you very much. My question really is about the labour market. I think one of the big puzzles has really been the resilience of the labour market around the world. And I wondered if you could make a few comments on why that's the case. Is it a lagging indicator? Is it labour hoarding, cyclical factors, or is it kind of more structural? We know, for example, during the pandemic, there was an increase in people leaving the labour force. Thank you.
Thank you. Okay, so there's one more question. Okay, two questions. So these are the two last ones, right? The hands I see up here. Sorry, I just said that. Okay, yes, so we can get the microphones there. And then in front of you.
Thank you.
Yes.
Chris Crowe from Capula. I just wondered whether there's a bit of a discontinuity on the issue of the labour market, where the sort of backward-looking indicators suggested really a very minimal impact on inflation, but looking forward, we're kind of thinking about labour market, wage persistence leading to persistent services inflation. I do think that that latter issue is a real concern, and it leads me to wonder whether the backwards-looking contribution has been sort of somehow underweighted.
Thank you. And so just in front of you, 2 rows, yeah.
Detlef Ramsdorff. I was 30 years ago at the Bundesbank. Thank you very much for this vivid discussion, but I was puzzled by a remark by President Lagarde, if I may have a question, because you said...
The questions are to the panel here.
Yeah, okay, but it's a general content. She was totally right, I tell you, in saying that we had... I think 2 years ago or so, a lot of problems as regards the supply side, the supply aggregate overall, because of supply chain problems, because of energy limitations, because of labor shortage and so forth. So it's very clear the supply side is very low, or even went down. And how could you, at this time, then increase aggregate demand, monetary demand? I mean, for me, it's maybe I have a simple thinking, but I thought that's very obvious that this would create inflation, and actually it did so. And we had this discussion in the newspapers here. Everybody said, well, how can you do that? And Mrs. Schnabel was very tough on that. She said, well, no problem at all. Now she is very tough and I'm in the front of fighting inflation. But why didn't you do that in the beginning? Because it was obvious. Thank you.
Thank you. So we have a round of answers. Let's go in the reverse order. Start with Evie, and Richard and Philip. And I think there were some specifically targeted, but most of the questions, essentially everyone can respond. So
all right, let me take the question of Victor that was especially for me. So what I had in mind, Victor, is that, if we keep tight when we should ease, maybe inflation will go below the 2% floor. So that's why I'm talking about risk of going back to target from below. And I say that I would prefer that in this kind of scenario. So that's what I mean. Now, I would like only to talk about one more thing, and then I leave the floor to Philip because it's all for him. So about the labor market. So the labor market, we talk about here changes in wages and services versus the total CPI, and we are worried how this is going to turn out. And in the whole discussions this morning, we didn't hear anything about that, but it could be that there is something special in the service sector happening that is actually the increase in wages in the service sector could be actually driven by a structural change. And the change is that we have a change in the model of working in services. Now, hours are much more flexible. You can work from home after the pandemic. Another thing is that we have actually also technological changes that might affect the service sector. Think about the GPT. And this could also affect productivity. So some of the increase in the wages could actually be a change in the trend that has to do with technology and nothing to do with the inflation. So this is something to take into account. And also in Europe, we have also another structural break, which is that after COVID, people realized it's better to work in the formal sector. So participation patterns in Europe were very different relative to the US. And this is something also to take into account. So I will leave it here. And to Richard.
Okay, of the several questions, I'll give my perspective on two. On the, Vitor, good to see you. On the fiscal theory of the price level, what I would say is, in fact, I was chatting in the car over this morning with someone on this. I think the reality is that in the real world, what we know happened is that there was a big fiscal response in the U.S., $6 trillion over 12 months, and most of that was checks that was sent out. It was transfer payments, appropriate. It wasn't not necessarily government spending. And so, if I were teaching principles of economics, there's a rightward shift in the aggregate demand curve so long as folks spend it, and that's going to lead to a higher price level at full employment, or even maybe higher if you have an adverse supply shock. So I don't think this episode in and of itself can render a verdict on fiscal theory. The cleanest fiscal theory experiments are ones where there's just a bunch of debt that's issued and without the offsetting other factors. So I think whether or not you have a traditional Keynesian view, new Keynesian view, or fiscal theory view, you would more or less predict a price level adjustment to the fiscal response that we saw in the U.S. Where John Cochran's arguments get interesting is more looking at historical periods where you can maybe get some perspective. On the other question that came up that I'll weigh in on, financial conditions. Obviously, that's important. The Fed talks about it. All central banks talk about it, just recognizing that in our models, DSGE models, the short rate path is a proxy for transmission. But in the real world, that's woefully incomplete. And of course, the Fed, in its recent commentary at the November Fed meeting and the December meeting, in the FOMC statement, actually made reference to financial conditions. That language was then taken out in the January meeting. I don't think it's because it's any less relevant. It's just it's not their focus now. But it's both a reality of doing monetary policy and a potential challenge. It's what's been Ben Bernanke's called the Hall of Mirrors problem. And I'm not saying that that's an issue now, but it's always a risk in which your transmission of your policy is a function of expectations about your policy. I don't think it's any worse or better now than it usually is.
Okay, thank you. And Philip?
Okay, thank you for the questions. I mean, maybe going to this issue about immaculate disinflation, I think a pretty big difference between Europe and the US is we've had two supply shocks. One, which is the pandemic, where I think everywhere the pandemic was very severe, but then the bounce back from the recovery from the pandemic improves labor supply, eventually reduces bottlenecks, and you get a lot of the kind of immaculate disinflation from that, absolutely. But we also had this really spectacular terms of trade shock. And that, even though it's retraced at some level, I mean, what Evie showed about economic policy uncertainty, part of that for Europe is, the future of the energy sector. So in terms of the kind of disappointing growth performance of Europe, and I showed the downward revisions we've had, I don't think this is pain-free. So part of the disinflation in Europe is coming from pain, which connects to that terms of trade shock. So I do think we have a different situation there. Everything I see is that monetary policy also has been effective. So it's within an overall narrative where the pandemic recovery is doing a lot. And so normally, if you were trying to squeeze a kind of overheating economy, monetary tightening would go with rising unemployment, rising credit risk, all sorts of financial amplification. We don't have that because the supply recovery from the pandemic means there is some support for the labour market and GDP. Okay, let me take on this very interesting question about the obviousness of policy making. So I did take the time recently because of the CPO report, which we then reproduced on the ECB website a week ago. So there's an ECB blog post where what I did is I went back to the documents we had for every meeting throughout the pandemic, throughout 21, 22. Okay, looking back at the decisions we made and in the context of what we knew at the time. And also not just, honestly, us. I went to what the BIS was saying in their quarterly meetings, what the IMF, what everyone was saying. And there were risks being flagged. But the policy conclusion was throughout 2020, and I would say for us, basically all of 21, it remained the case, Europe needs to deliver favorable financial conditions. And that was our overall mantra in 2021. The counterfactual in terms of what we did in the pandemic was to avoid the tail scenario, both us and the fiscal policy, which is if you go for a long time without making any money, what kind of scarring do you have in the corporate sector? What kind of scarring do you have for households? So in terms of, I think what Richard showed about loss functions, and those are the central bank loss functions. You also have to think about what the kind of social loss function is, what the governments were trying to do, and so on. So I do think throughout most of 21, we can debate maybe earlier in 21, you could have pivoted. A lot of support was appropriate. Then the big question is, how do you pivot from there to being suitably restrictive? And this is where the second shock in early 22 of the war. So if you like, if you're saying, well, in 2020, I think the jury's going to be out for a long time about how much of the inflation we saw in 22 was predictable in 21. So internal dynamics taking off versus essentially the second shock in 22. Because unless you have a theory of why the war was driven by monetary accommodation in 21, that second shock, I think, is really important. I think I will let many study this for a long time about how quickly could we have pivoted. Could we have pivoted more quickly? Could we have, so the first 6 months of 22, downscaling from large amounts of QE to zero by mid-year, and then we started hiking. The hiking was anticipated, so the yield curve already moved. But what I showed, and I did show it there, was counterfactuals about where we tightened earlier, how much the inflation would have been lower. It would have been, but let's not pretend it would have been stuck at 2%. So let me go back to my basic point here is, if you think accommodation was not appropriate in 2020, 21, okay. If you think throughout the whole time ECB could have not been expansive, that's one version. If you think in 2020 and a lot of 21, a lot of accommodation was needed, then you have a much more narrow debate. And I would invite you to debate, honestly, that's where I would say the live debate should be. Because, and then, I don't know your individual circumstance, but those who think it was perfectly obvious, you weren't showing up in the financial pricing at the time. So let me stop.
Okay, thank you very much. So we had a spirited morning. Round of applause. And thank you also again to President Lagarde for your speech and for staying here. Thank you.